This podcast is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research before making any investment decisions. Hey guys, how's it going? Welcome back. I am pumped for this one because today I'm going to do something I've never done on this show before. I'm going to walk you through, position by position, every single monthly dividend ETF in my portfolio and show you exactly how they add up to over $8,000 per month in passive income. No hypotheticals, no back-tested projections. These are real brokerage deposits hitting my account every single month in 2026. And I know $8,000 a month sounds crazy. It sounds like one of those clickbait thumbnails where someone's holding a stack of cash next to a Lamborghini. But here's the thing. When I pull up my portfolio tracker, the total annual dividend income across all positions comes out to just over $102,000. Divide that by 12, you get about $8,500 a month. That is real. That is happening. And I want to show you exactly how I got here so you can start building something similar, whether you're at $10,000 or $1,000,000. Now, the total portfolio value sitting across all my accounts right now is about $1.33 million, generating that 102K in annual income. That works out to roughly a 7.7% blended yield across everything. And the key word there is blended, because some of these positions are yielding 3%, some are yielding 10, and one of them, well, we'll get to that one. It's a monster. So here's what we're going to do. I'm going to go through each of my 7 monthly dividend ETFs one at a time, give you the share count, cost basis, current price, annual income, and monthly income from each one, and a running total like a scoreboard so you can see how it all stacks up. Let's get into it. All right, we're starting with the two heavyweights, the bread and butter, the ones that most dividend investors already know and love. First up, JEPQ. That's the JP Morgan NASDAQ Equity Premium Income ETF, ticker JEPQ. This is one of our biggest monthly income positions. We hold 2,020 shares at an average cost basis of $47.81 per share. The current price is $58.52, so we're sitting on some nice unrealized gains there. And the income, $1,402 per year. That breaks down to roughly $1,033 per month, just from this one fund. Now, the current yield on JEPQ is 10.31%, which is honestly one of the highest you'll find among the big established options-based ETFs. And here's what makes it interesting. Its 5-year price compound annual growth rate is 15.4%. So you're not just getting income, you're getting meaningful capital appreciation too. That's a combo you don't see very often in the high yield space. The total dividends we've collected from this position so far, just under $16,907. That's real cash that's already been deposited. Now let's talk about its sibling, JEPI, JP Morgan Equity Premium Income ETF, ticker JEPI. We hold 1,933 shares at a cost basis of $55.31. Current price is $59.62, so we're in the green here too, though not as dramatically as JEPQ. Annual income from JEPI is $9,163, which works out to about $763 per month. The current yield sits at 8.06%. So how do these two compare? Here's the way I think about it. JEPQ is like JEPI's more aggressive younger sibling. It tracks the NASDAQ 100, so you get heavier exposure to tech names, which means more upside potential, but also more volatility. JEPI, on the other hand, tracks the S&P 500, gives you a broader, more defensive profile. It's the steady one, the one that lets you sleep at night. Both of them use a similar strategy under the hood. They sell out-of-the-money call options on their respective indexes to generate premium income, which is what gets distributed to you every month. It's not magic. It's just a disciplined options selling approach managed by JP Morgan's team. The trade off is that in a raging bull market, you might leave some upside on the table because those call options cap your gains. But when the market is flat or slightly, these things are printing income like clockwork. Now, JEPI has over $41 billion in assets. It's massive. It's one of the most popular ETFs in the entire market right now. And for good reason. It delivers exactly what it promises: consistent monthly income with lower volatility than the broader market. So let's update our scoreboard. JEPQ gives us 1,033 a month. JEPI adds 163. Our running total after two positions, $1,796 per month. Solid start, but we're nowhere near eights because we haven't talked about the one position that changed everything for this portfolio. This is the one that most people don't know about, and honestly, it's the one I get the most questions about. BTCI, the NEOS Bitcoin High Income ETF, ticker BTCI. Now, before you roll your eyes and think I'm about to pitch you on some reckless crypto yield trap, hear me out. Because I've been very vocal on this show about the risks of chasing yield, I spent an entire episode tearing apart MSTY and why I think it's a yield trap. BTCI is a different animal, and I want to explain why. We hold 3,506 shares. Our average cost basis is $51.65, and the current price, $33.42. Yeah, I know. That's a significant NAV decline. I'm not going to sugarcoat that. On paper, this position is underwater from a price perspective. But here's where the story gets interesting. The annual income from this single position is $57,106. Let me say that again because I want it to sink in. $57,000 a year from one ETF. That's $4,758 per month. This one position alone generates more monthly income than most people's entire dividend portfolio. Now, how is that possible? The NEOS Bitcoin High Income Strategy uses a combination of Bitcoin exposure and an options overlay. Specifically, they're selling covered calls and utilizing tax-efficient option spreads on Bitcoin-related assets. It's designed to harvest premium from Bitcoin's insane volatility. And Bitcoin is one of the most volatile asset classes in the world, which means the options premiums are enormous compared to what you'd get from selling options on, say, the S&P 500. Now, here's where I want to be honest with you guys. The total dividends I've received from BTCI so far are about $13,083. My cost basis on this position was roughly $181,000. So have I made back my full investment yet? No. But the income is stacking up fast. And if Bitcoin stabilizes or goes higher from here, the math starts looking really favorable. And the reason I think BTCI is fundamentally different from something like M, which I criticized pretty heavily a few episodes back, is the approach. MSTY is a single stock covered call fund on MicroStrategy with that absurd headline yield that's largely funded by returning your own capital. BTCI uses a diversified option strategy with tax loss harvesting built in, and it's managed by NEOS, which has a solid track record with their other income funds. Is there risk? Of course. If Bitcoin crashes 50%, this position is going to hurt. But I sized it knowing that, and the income it generates while I hold it is substantial. All right, let's update the scoreboard. JEPQ gives us 1,033. JEPI adds 763. BTCI throws in 4,758. Running total, $6,554 per month. Now we're getting somewhere. Okay, let's talk about the supporting cast. These are the positions that push us over that $8,000 mark. First, STRC, Strategy Incorporated, ticker STRC. This used to be known by a different name, but it's essentially a company with heavy Bitcoin treasury exposure that also pays a dividend. We hold 521 shares at a cost basis of $95.93. Current price $99.96, so we're slightly in the green. The yield is 11.27% and it generates $5,863 in annual income. That's about $488 per month. Now, what makes STRC interesting compared to something like MSTY is that you're actually owning equity in a company that has operating revenue and a dividend policy, not just a synthetic options wrapper. Is it risky? Sure. It's concentrated in Bitcoin exposure through its treasury strategy, but I'd rather own the equity directly and collect an 11% yield than own a covered call fund on top of it that erodes the NAV. That's the distinction I keep coming back to. Total dividends received from STRC so far, $1,370. It's a newer position, but it's already contributing meaningfully. Now, the remaining 3 monthly payers in our portfolio are much smaller. I want to be upfront about that. These are experimental positions. Think of them as test drives. CHPY, the Yield Max Semiconductor Portfolio Option Income ETF, ticker CHPY. We have just 2.25 shares worth about 137 bucks. It generates about $43 a year. Tiny. But I wanted exposure to a semiconductor focused options income fund just to see how it behaves over time. PLTW, the Roundhill Palantir Weekly Pay ETF, ticker PLTW. About 2.5 shares, 60 bucks in value, generating around $78 a year. This is another small experimental allocation, a weekly paying covered call fund on Palantir. It's an interesting concept, but honestly, the position is too small to move the needle right now. And finally, IAUI, the NEOS Gold High Income ETF, ticker IAUI. About 10.5 shares, $655 in value, generating $53 a year. This is a gold-focused income play from the same NEOS team that manages TCI. I added it to get a small taste of commodities income. Now, I'll be real with you guys. Those last 3 positions combined contribute maybe $15 a month. We're not material to the income story. But I like having them as small lab experiments because they teach me how different asset classes behave inside an options income wrapper. And if I like what I see over the next 6 to 12 months, I might scale them up. So let's do the final math. Let me add it all up. JEPQ, 1033. JEPI, 763. BTCI, 4758. STRC, 488. CHPY, about $4. PLTW, about $6. IAUI, about $7. Grand total from monthly dividend ETFs alone, roughly $7,056 per month. Now, you might be thinking, wait, you said over 8,000. Where's the rest? Great question. The rest comes from the quarterly payers in the portfolio that, when you annualize everything across all positions, including SCHD, VOO, VTI, DGRO, and the others, the total portfolio income comes out to that $102,937 per year, which is $8,578 per month on average. The monthly payers do the heavy lifting, and the quarterly payers fill in the gaps. And that brings me to the bigger picture. How do all these monthly income ETFs fit alongside my core holdings? Let me zoom out for a second. Our single biggest position by far is SCHD, the Schwab US Dividend Equity ETF, ticker SCH, hold over 12,600 shares across accounts with a total value of about $398,000. It's been looking at $1,000 a year in dividends, but SCHD pays quarterly, not monthly, and the yield is 3.51%. So it's not going to show up in a monthly income breakdown the same way JEPQ does. But here's the thing. SCHD is doing something the monthly payers aren't. It's growing. The companies inside SCHD are consistently raising their dividends year after year. That means 10 years from now, our yield on cost on SCHD could be 6, 7, maybe 8% without us buying a single additional share. That's the compounding magic of dividend growth. Same idea with VOO, Vanguard S&P 500 ETF, ticker VOO. We hold over 400 shares worth about $260,000. The yield is only 1.11%, but the capital appreciation is where the real wealth building happens. VTI, Vanguard Total Stock Market ETF, ticker VTI. Similar story. About $133,000 in value, yielding 1.1%, but giving us broad market exposure that should compound significantly over the next decade. And DGRO, iShares Core Dividend Growth ETF, ticker DGRO, about 29,000 in value. We talked about DGRO a few episodes back when I was diversifying beyond SCHD. It focuses specifically on companies with a track record of growing their dividends. Love that fund. The philosophy here is pretty simple. The monthly payers, JEPQ, JEPI, BTCI, STRC, those fund current lifestyle expenses and give me cash flow I can either spend or redeploy. The quarterly growers, SCHVTI, DGRO, those are the long-term wealth engines. They're building the base that will be income 20, 30 years from now. It's the core and satellite approach I've talked about before, but now you can see it working in real time with real numbers. All right, let's wrap this up by talking about what I'd actually do with new money today. If I had, say, $50,000 to deploy right now into monthly dividend ETFs, how would I rank these 7? Honestly, BTCI is the one that tempts me the most from a pure income standpoint. The NAV decline is concerning, no question, but at $33 a share, I'm actually getting a better entry point than my original cost basis of $51.65, and the income generation is just staggering. If you believe Bitcoin is going higher over the next few years, and I do, then BTCI at these levels is arguably the most interesting monthly income play out there. JEPQ and JEPI are both trading near their 52-week highs right now. JEPQ is at 58.52 with a high of 60.14. JEPI is at 59.62 with a high of 59.72. So these are pretty extended. I'm not selling. I'm collecting the income and letting them ride. But if I was adding new money, I'd probably wait for a 3 to 5% pullback before loading up. STRC at just under $100 is in an interesting spot. It's near my cost basis. The yield is over 11%, and I like the company's direction. I'd be comfortable adding a little more here. The smaller positions, CHPY, PLTW, IAUI, I'm honestly still in observation mode. I need to see more data before I commit real capital. They're fun experiments, but they haven't earned larger allocations yet. And one more thing I want to mention before we go, taxes. This is something that doesn't get talked about enough in the monthly dividend ETF space. Most of the income from these funds, especially the options-based ones like JEPQ and JEPI, gets classified as ordinary income, not qualified dividends. That you're paying your full marginal tax rate on that money, not the lower qualified dividend rate. For someone in the 22 or 24% bracket, that's a meaningful difference. So if you're building a portfolio of monthly payers, strongly consider holding them in tax-advantaged accounts like an IRA or Roth IRA when possible. That's one of those details that can save you thousands of dollars a year. And if you want to track all of this the way I do, every position, every dividend, projected annual income, yield on cost, all of it, check out retireearlywithdividends.com. It's a free tool I built specifically for dividend investors. You can screen for monthly payers, see real-time yields, and build out your income projections without any guesswork. I use it literally every day to monitor this portfolio, and it's honestly the easiest way to see exactly where your dividend income stands. All right, guys, that's the full breakdown. 7 monthly dividend ETFs generating over $8,000 a month combined with the rest of the portfolio. Real positions, real numbers, real deposits hitting the brokerage account. I hope this gives you some ideas for your own portfolio, whether you're just getting started or you're looking to add more monthly income to what you've already built. If you enjoyed this one, make sure you subscribe so you don't miss the next episode. I've got some great content coming up. Until then, keep those dividends rolling, and I'll see you in the next one.